And we are just moments away from the start of trading. And this is Bloomberg Open Interest. I'm Sonali Basak, taking a look at futures still, waiting for those bells to open. We're looking at futures still on the rise, waiting to snap back. December was sad, but January is in the green firmly. But this week still has been a choppy one. Today could change the game. We are looking now at the opening bells, of course, at the NASDAQ. A lot of excitement over there. And, of course, at the NYSE as well as at the NASDAQ. I'm sorry, this is the NASDAQ. That is the NYSE. Waiting for those opening bells to get started. Of course, ending on what has been a very volatile week. Let's look at markets now as they open up. As we've been saying, the S&P 500 now up 0.5%. This would bring you into green territory for the week if we continue those gains throughout the day. The NASDAQ 100 up even more, 0.7%. As we've been talking about, the DeepSeek moment was just Monday. Big tech now coming back to life. Russell 2000 was negative pre-market. You are looking at it also trying to come back into the green. Let's also flip under the hood here. Let's look at some stocks to watch as well, because this was the start really of a big energy earnings in addition to big tech. Chevron had raised dividends by 5%, but had profit underperforming expectations last quarter. The company will lower capital spending this year for the first time since the pandemic. You're watching Chevron shares down more than 2% as the market opens. ExxonMobil still up 0.6%, reporting strong production and beat estimates. But we're going to go back to big tech. We're going to go to Romain for that.
We have to go back to big tech. A big part of the reason why you're seeing the NASDAQ higher is because of, Intel actually opened higher here. And as I turn around now, flipping into the red. But keep an eye on the tech stocks, a better than feared revenue coming out of the big chip maker here. Now, their guidance going forward, that was somewhat tepid. And of course, no real guidance here on the CEO situation. Those two co-interim CEOs still taking it slow. Meanwhile, Apple trying to give a big boost to this market. Greater China revenue in the most recent quarter did fall, down about 11% in the most recent quarter as the iPhone continues to lose market share. But the services division, that grew 14% worldwide and a promising revenue outlook for the current quarter. A big part of the reason why you're seeing Apple up 3.5% on the day, and a big part of the reason why you're seeing it about to post potentially its best week in months. Let's bring in Caroline Hyde, the co-host of Bloomberg Technology. I'm familiar with her. You take a look at Apple, Caroline. You take a look at that report that we got out of last night. I thought the shares would be down. Why are they up?
Tim Cook did a very good job at talking up the opportunity remain of Apple Intelligence, the opportunity to have private servers, silicon integrated, so you get a more private AI experience. And that's what's being thought of as underappreciated by some of the analysts. I also thought the CFO, new to the job, of course, he's a long-time executive at Apple, but recently took on the helm in January of the CFO role, talking up about the next fiscal quarter. We're going to see 4% revenue growth once again. That relieved the anxiety that Chinese weakness, that iPhone weakness isn't going to leach into forward forecasts, and they're still going to be stable.
I also want to switch gears just a little bit, because in addition to earnings, you have some big moments for the relationship between the AI industry at large and the White House. You have NVIDIA CEO Jensen Huang visiting that White House now as well, right after the DeepSeek moment and in the middle of billions of dollars pledged towards AI. What does this all mean?
Well, he hasn't been there yet, and so he's probably been waiting for this invite, but what a time to be doing it, because as you've been reporting across all of your hours, the White House and indeed Microsoft and OpenAI first trying to investigate what indeed DeepSeek was up to in terms of being able to use this distillation technique where you're taking out some of the learnings of the overall model and use it yourself without perhaps investing so much in the overall compute power. But now people want to understand, did they actually have access to NVIDIA chips they shouldn't have done? Have these chips been being sold via countries such as Singapore? Have they been able to basically make the most of access that actually is managing to bypass some of these imposed restrictions? Now, NVIDIA have been very clear on this. They have thought that no, DeepSeek did not get hands on any chips they shouldn't have done. Everything was in line with restrictions, and they just have done more with less, with some of those more sophisticated chips weren't necessary. They front-loaded getting them ahead of some of the restrictions, and then they used some of the weaker ones, but to the opportune degree. So we'll have to see whether Jensen Huang can shed any light on whether further restrictions are really necessary here.
Looking forward to all your coverage of this, of course, on Bloomberg Technology at 11 o'clock. That is Caroline Hyde, co-host of Bloomberg Technology. We're going to broaden out the conversation now. We're going to speak with Citi U.S. equity strategist Scott Chronert. And it's interesting, Romaine and I all morning have been talking about the underperformance, the relative underperformance of the technology sector when you look at this market broadening. Some people are excited about it, this idea that you could find gains elsewhere. But with the concentration of markets, the S&P 500 in particular, to big tech, is it concerning that you've seen this general sense of excitement starting to wane a bit?
You know, Sonali, it's an issue, but I think for now it's a good issue, right? So we've been arguing for some time it's a healthier bull market, if you will, if you're getting more support across the sector and industry group spectrum. And that's what we've gotten so far this year. Here we are a month into the year, and who would have thought the index would be up 3% and tech would be your laggard, the only sector down thus far for the month. So the broadening aspect here is mission critical to ongoing equity gains from here. It's part of our playbook for 2025. And what I would say is that we're navigating the DeepSeek issue quite clearly, but the broadening effect in terms of more parts of the market contributing constructively to index fundamentals that we think is a really important tailwind for U.S. equity investors.
How sustainable is that, Scott? Because we've been here before where we've started to see kind of the rest of the market, if you will, finally sort of show up to the party. I know we still have to get deeper into the earnings season to get to some of those mid-cap names that kind of make up the bulk of the Russell 1000 and the Russell 2000 as well. But are you confident that we'll see a follow-through?
Well, I think we're going to see a follow-through. It's a question of the timing of the Romaine, because the way we've been looking at it is that first quarter for us has actually been sort of a maximum volatility risk period because, yes, we're getting the solid earnings reports that we'd expected going into Q4 earnings. That isn't a big surprise. But we're just now starting to get a little bit more clarity on where Trump policy perspectives are taking us. And I think for now, the market is kind of viewing the aggregate aspect of Trump policies as a net positive in terms of its business-friendly nature. But we still have some specifics that we're going to have to navigate. So don't think volatility has been put aside just yet. But under the surface, ongoing earnings broadening as the economy continues to show a fairly degree of strong robustness, we think is all really, really constructive in terms of the full year picture for U.S. equities.
You know, going back to that mission critical statement that you made about this broadening trade, I want to pull up what it looks like the S&P equal weight versus the S&P 500. Year to date, the S&P equal weight is winning. And that is a trade. When we talk to prime brokerages across the street, you see people buying ETFs really tied to that index, this excitement around the broadening. How heavy, Scott, do you go into that trade?
Well, we've been saying go in pretty heavy. We've been arguing, for example, either from a sector perspective, we went into this year overweight communication services, along with energy, financials, and we even put healthcare in, which is getting a good rebound after a fairly tough 2024. This broadening, we think it's potentially long-lived here, but it kind of goes hand in hand with, as I described, this ongoing tailwind to underlying U.S. economic activity that ultimately begins to benefit from some improvement globally as you see central banks around the world begin to go down an easing path. So we think there's legs here, but again, we just have to be careful that all of this is still with a presumption that Trump policy influences are neutral to positive, and that still remains to be seen as we get to some of the policy details we expect will be forthcoming in the weeks ahead. You know,
Romaine, if Katie Greifeld were here, she'd be looking at the Russell 2000. Yeah. The S&P equal weight this month has outperformed the Russell, it's outperformed the NASDAQ, and it's outperformed the S&P 500.
Absolutely. And even within tech, you talk about some of kind of the older tech companies now at the top of the leaderboard. I mean, we talk about names like IBM and Oracle. Scott, I do want to talk to you, though, a little bit more about the potential risk. And I think Monday, coming into Monday's session, was kind of a reminder, of those potential gray swans, if you will, that are out there. The president has made it clear, at least, if you take him at his word, that he's going to follow through with these tariffs over the weekend. When you start to dissect the sectors and the companies that could potentially be affected by this, do you wait and see for those policies to be implemented, or do you react on the word of the president himself?
Well, I think the market is clearly in wait-and-see mode, and you're seeing this in the sector price action as well as we look at the January performance. So the way we sort of aligned it is that going into this year, our underweights were fairly clear. We're underweight consumer discretionary, we're underweight industrials, staples, and to a certain degree materials as well. Now, those are all for a variety of reasons, but back of our mind, we think that's also where your maximum tariff risk and exposure probably comes from. So we don't mind being of the view that there's going to be some differentiation within the index as we go down this path. And what we have to be very sensitive to is that, as you go down the tariff math, it is going to be a little bit more company and sector specific, a little bit less of a fuller index issue, but nevertheless still an issue.
And it's not, but I just want to stop you there because it's not even just the direct impact too. I mean, Scott, we did hear from some companies this week that reported earnings about the headwinds that they had from a higher dollar, basically that FX headwind. And if you believe that tariffs could be inflationary and obviously boost the dollar further, does that now have to be rejiggered in those models?
Yes and no, because the tariff component is quite complicated and we still don't really know specifics, right? But what I would say is that the dollar strength, we view this as one aspect of the market starting to price in tariffs and inflation risk ahead of time. So a lot of what's happening here in terms of how do you position for some of these Trump policy effects, what we're suggesting is in U.S. equities, it's very hard to get really dialed in terms of where the focus is going to go. But from a macro perspective, you can certainly go down the dollar path as a very clear, distinct way of expressing this hedging view, if you will. So, we have to be careful. There's lots of moving parts still to be played out here. So we just want to be mindful that, the fundamental story as we go into the Q4 reporting period is pretty solid. It is going down into small mid cap, which has been a call of ours going into this year. But it's a little bit tricky to say that we're in the clear yet. We still have to get a little bit further down the more specifics of this policy path, I think, to kind of really wave that coast as clear flag. We've been arguing as we get towards mid-year, but for now, I think what we'll take is the constructive setup we're seeing from this broadening earnings picture. It's a big deal. It's very healthy for the markets. We think it's poised to continue.
Scott, thank you so much for joining us today to end off this week and the first month of trading. That is Citigroup's Scott Gronert. Now, I want to bring you some breaking news as well, because big talent over at JP Morgan, Jason Sippel, is leaving the firm. You have Pranav Thakur, who is going to be named the sole head of Wall Street's biggest trading desk. These were two men that were elevated just a year ago when Troy Rohrbaugh was elevated to co-lead the entire commercial and investment bank. You have Jason Sippel leaving to join Chris Rokos Capital Management. It, Romaine, is just another example of that heated talent war on Wall Street between the big trading desks.
Yeah,
these massive
and we've been talking a lot about that and how you have to either compensate these folks or they're going to walk because there are better opportunities out there, at least on a financial basis. And for that matter, it's not even just about the pay also. It's also about kind of, the thrill of the hunt. And you're not always getting that at the big banks these days.
Yeah, but over at JP Morgan, for Pranav Thakur, who is taking over the whole business alone now, it certainly is now another person to watch over at JP Morgan, expanding his remit here as somebody exits.
And meanwhile, we continue to watch the financial markets here in the U.S., which are now open. The S&P 500 up about 0.4%. Some of the biggest individual movers on the day. That includes Visa. Earnings are out, and they did get a boost from the holiday season. A modest jump in the shares on the day, up about 1%. Meanwhile, Deckers Outdoor, you know them. They make all those big chunky shoes that Katie Greifel loves. Uggs, Hokas, everything else. Weak annual sales outlook here, despite the fact that I finally got my first pair of Uggs this holiday season.
And you might not know this, but she buys the Uggs or the Crocs? What is it she wears? The clunky shoes?
Yeah.
I wear the Boot Barn shoes.
The Boot Barn. Well, apparently Boot Barn not doing all that great either. I've never set foot in a Boot Barn. I don't know if it's an actual barn or not, but a profit forecast that did disappoint investors. Seeing those shares moving down by 7% here on the day, that's setting up, I think it's going to be one of the worst days that we've seen for this company in quite some time.
How many cowboy boots can you really buy?
Is it cowboy boots?
Oh, yeah.
Oh, I didn't know you were a cowboy boot person.
9 pairs last
I don't think I've ever seen you outside the office, so you're always just in your anchor person dress.
This is the problem with the afternoon and the morning.
Who knows what goes on outside of work?
Anyways, coming up, Wall Street is weighing in on the cocoa crisis, but it's anything but sweet for Hershey in particular. We're going to talk about that in Top Calls next. This is Bloomberg. And it's time now for our top calls, some of the analyst action in focus this morning. And first up, Piper Sandler is downgrading Hershey to a sell. The analyst says higher cocoa costs will last longer than initially anticipated, and it will pressure profits, especially next year. Piper is also downgrading Mondelez International for the same reason. And next up, Electronic Arts is getting upgraded to a buy at MoffettNathanson. The analyst says the risk reward for the video game maker is attractive for the first time in a while. And finally, UPS, no longer a buy at Baird. The firm is downgrading the shipping giant to neutral after it projected annual revenue that was well below expectations. UPS slashed its low-margin business with Amazon and told investors that a demand rebound just isn't going to happen this year. Now coming up, buyout firms are hoping there's going to be an IPO boom this year. We're going to discuss that with Houlihan Lokey's Matt Swain in our Wall Street Beat. This is Bloomberg. And it's time now for the Wall Street Beat. Buyout firms have been holding on to assets that they need to sell or IPO, and the clock is ticking. Their own backers are waiting for a return on their investments. And to start 2025, equity capital markets have been fragile, and very few private equity-backed IPOs have actually come to the surface. Are they coming? Matt Swain, who is Houlihan Lokey's head of direct placements and secondaries, joins us now. And there's this problem underneath the surface. These private equity firms have been holding on to their assets until kind of the end of their hold period, to the point you see them taking out debt to try to give money back to investors. Why aren't they going public now? Are they too upset still with the prices they're getting on PE assets?
Yeah, look, Shonali, over the last year, the exit environment obviously was not what we expected. That being said, as we enter 2025, we expect a tidal wave of deals. I think this is going to be driven by a couple of different factors. One of the factors is the fact that we have $500 billion sitting in dry powder that will either expire and have to go back to LPs or actually be deployed by private equity firms. My bet is it will be deployed. I also think you're going to see interest rates come down even slightly. That'll make debt cheaper, and ultimately you're going to see more IPOs based on that. Now, I'm not technically an IPO analyst by any means, and that is not necessarily my domain, but I do think you're going to see a series of deal making leading into this year.
Now, I want to bring up also, just yesterday, you had Blackstone reporting their own results, and they said that they had the best deployment in 2.5 years. And next week, we're going to hear from the likes of Apollo and KKR. Ultimately, these large firms, are they indicative of what you're seeing across the industry? Because we are seeing kind of the big get bigger here.
Yeah, it's a good question. What I would tell you is we are seeing a denominator effect with LPs. LPs are over-allocated to the public markets right now, and they need to find exposure through private equity. I think just from our directs market, the directs market hit a record $50 billion this past year. That's LPs trying to get exposure as quickly as possible to the private markets. And I think that's really a bellwether of what's going to go on throughout 2025.
Do LPs have that cash, though? I mean, one of the big complaints that they've had is that they're still kind of locked in on the past deals. Where's that liquidity?
Well, look, secondaries is really what's driving the liquidity for at least some of these investors. That's the reason it hit $160 billion. When I was on the show, I guess it was 3 or 4 months ago, I said we thought it might hit $150 billion. It blew past that.
Yeah.
I wouldn't be surprised, by the way, at least in Q1, if we see another record year or at least record quarter for the secondary market, and that's helping with exits.
And I just want to explain, the secondaries are when the LPs are buying fund stakes.
Gotcha. But is that indicative of a healthy market? When I see secondaries at a record high, I mean, I know it's great for you, but when I see it at a record high, and then you're saying that maybe potentially we could see another record, isn't that sort of indicative that there isn't necessarily an exit plan?
Yeah, look, there's two driving factors. The first factor may be not as healthy. That's private equity firms trying to hold on to their assets. The second factor is healthy. I would tell you the secondary market, which is really a private equity firm holding on to a continued interest, they're trying to do this more and more with their trophy assets. That is healthy. So I do think you have two counteracting factors there.
You know, it's interesting because the debt markets have been so open this year, and I wonder if that's a good or a bad thing, because you expect more exit opportunity. You're seeing people buy things, fine, but you're not seeing them sell things and give that money back to investors.
Yeah, look, I think you are going to see people sell things in 2025. The sponsor-backed new issuance market doubled actually last year. Now, most of this was done because of refinancings. It went from $150 billion to $300 billion in 2024. I think that will continue to increase. I actually think you are going to see more deals happen in 2025, and this route of lack of exits is going to be over.
I am curious, too, about the idea of cross-border transactions. And I know this kind of gets a little bit in the weeds here, but we've spoken with a lot of folks that were saying that one sort of path, at least prior to the new administration coming in, was the potential for cross-border deals. And given the rhetoric out of Washington, it doesn't seem like that's going to be an easy path at all.
Look, I won't comment on the current administration or the politics of the current administration. That being said, I do think folks are in tune to what's coming out of Washington. They're hearing what people are saying. And from the direct's point of view, we are seeing more deals get done in the United States than cross-border.
Matt, we have to leave it there. We thank you so much for joining us today. This has been a big topic under the surface because, of course, that private equity comeback is a big part of that M&A market overall. Fees for investment banks under the surface at stake. Anyways, a check on stocks here as well, because we are almost a half an hour into the trading day, and you're watching that snapback in the S&P 500 up about 0.5%. And remember, if we continue to see those gains, we are bringing that S&P 500 into green territory for the week. The NASDAQ 100 is flying. Is that fair to say? It's up about 1.1%. 1% relative to what we saw this week. That's a good story. The NASDAQ 100, though, is really eclipsing the Russell 2000, has had trouble today breaking into the green, but generally the Russell 2000 this week has done quite well as rates have really stabled at that 4.5% level on the 10-year.
Yeah, I mean, tech stocks are doing their thing, but kind of interesting. You talk about the Russell being down. Look at all the energy names still lagging. So kind of the shakeout from what we saw with DeepSeek, a rebound in some of those tech names, particularly in the software space. But a lot of those energy infrastructure names still in the red.
The drill, baby, drill rhetoric not really getting to the energy sector here.
I just bought a drill, by the way.
Now, coming up in the next hour, we're going to talk inflation with the CEO of Brinker International, the parent of Chili's. Stick with us. This is Bloomberg. And we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Sonali Basak.
I'm loving the music you guys got in this show. It got a little bit of rock feel to it. I feel Matt Miller was probably behind that. Matt Miller and Katie Greifeld are both off. Romaine Bostick here, and coming up on the big show, from the DeepSeek sell-off to Trump's tariff showdown, markets recovering from an incredibly volatile week. Earnings season a big part of that. Rolling on, we're going to dig deeper into the results out of big oil. Exxon beats and Chevron falls short. Plus, a sizzling stock, Chili's, The parent company, Brinkers, on fire. Eat, the best ticker on the street. Thanks to strong sales, the CEO joins us later this hour.
And let's get a check on the markets because we are ending the week strong. We're looking at the S&P 500 up about 0.5%. The NASDAQ 100 even stronger, up about 1.2%. Thanks to Apple, I would say the 10-year yield at 4.5%. This looks like the level that investors are sticking with. And honestly, we're down more than 10 basis points before Inauguration Day. Now, joining us now, Emily Rowland, Co-Chief Investment Strategist at John Hancock Investment Management. Let's start there. Let's start with where interest rates are right now, because it looks like that 4.5% has been where stability has been for some time. But then you have this tariff threat, this idea that you can see the instatement of tariffs. We're waiting to hear from the president as early as tomorrow. Is it a threat? Is it real? Is it happening? What does it mean for interest rates ultimately to you?
Yeah, great question. And we are sort of in the sweet spot right now where rates are suggesting that the economy remains on solid footing, but they're not so restrictive that equity markets are reacting in negative fashion to the prospect of a higher borrowing cost, higher cost of capital. Again, tariffs, the headlines are all over the place. We try not to react too much to them. But one thing that's really notable, Shonali, that we've seen is that non-U.S. equities are on a tear. They've done great this week. And one reason for that may be sentiment around tariffs, the fact that they're going to potentially be more concentrated in areas like Canada and Mexico, and perhaps at least for now, China and other parts of the overseas markets may be spared. So we're seeing that in the outperformance of equities. It remains to be seen how this impacts rates. We are watching currency markets closely here. Widespread tariffs do have the potential to create an appreciation in the U.S. dollar as our goods become more competitive here. Typically, that's accompanied by higher rates, but still the messages are really all over the place, and it's hard to make a lot of changes in portfolios based on this rhetoric.
I am curious about that rotation that we saw over the past few weeks into those European stocks, the outperformance basically almost double, at least on the benchmark European index relative to the S&P. Is that driven, though, by fundamentals? Because I thought the whole lagging effect that we had seen in a lot of those European stocks is they just don't have the profitability and cash flow that their U.S. peers do.
That's exactly right. And we're a bit baffled by it, frankly, because the fundamental story supporting non-U.S. markets really isn't there on the earnings front. In fact, we've seen some pretty big notable misses in terms of the companies that have reported in Europe so far. And meanwhile, you wake up every morning and the DAX is at a new all-time high. So we do think part of this is sentiment driven. Again, this idea that tariffs may be more tempered there. We always believe over time that stock prices follow profits. They follow earnings. And it's a key reason we have been emphasizing U.S. markets in portfolios. We've got about 35% of companies now in the United States having reported earnings growth is coming in around 13%. You guys have talked a lot this morning about the breadth that we're starting to see, which is really healthy. Financials earnings up 80% year over year. Of course, the comps helped a lot on that front, but we're really seeing more participation from areas in the market given those earnings trends are starting to broaden as well.
You know, I'll bite. I was telling the team that I've become SPW girl on this show to the extent that Katie Greifeld is pitching holding on to that Russell trade and looking at how that's been performing. I've got to wonder, and I'll start February off this way too, is that a trade that investors trust more than the Russell 2000, especially when you think of the underlying dynamics here. If some of the rhetoric is supposed to help small caps, then which is going to perform better over the next year, the Russell or the equal weight?
Yeah, so we do think that small caps will have their time in the sun, but it's not yet. So I think small caps, it's notable to see how tied they are to rates. And the idea, of course, being as the cost of capital comes down, that's a relief for those smaller companies because they have higher levels of indebtedness, they have lower quality balance sheets. But the thing that I think is often missed is that remember that rates are coming down because growth is slowing. And we actually do see the U.S. economy slowly slowing. booming, for lack of a better word. And that would not be the most ripe opportunity for small cap stocks. Again, they're lower quality, their balance sheets are not as strong. We still want to lean into quality in the United States. Some areas that we're finding opportunities are areas like more cyclical industrial stocks. So if you want to have cyclicality in portfolios, we would be looking to things like U.S. mid-cap stocks, which have an overweight to industrials, which are benefiting from onshoring trends. So we're seeing supply chains continue to come to the United States from other parts of the world. And really all the investment around that, we think is really going to be accretive to earnings in the industrial space. Areas like healthcare, which are now trading at a 20% discount to the broad market. So we want to find quality, but we're looking to find it at a reasonable price. And those are some of the pockets of opportunity that we would prefer rather than fully leaning into small cap equities at this point in the cycle.
You know, it's interesting. A lot of the trades that were working last year, you're now almost 2 weeks into the Trump administration, and those trades now look to be not as obvious anymore.
Yeah.
It looks like you have investors hearing Emily speak really recalibrating now that we have more information.
Yeah, I think a lot has shifted, definitely in terms of sentiment. And a lot of that, of course, is because the president shifts and he'll continue to shift. And Emily, we've been here before. We had 4 years of this.
Yeah.
So we know that, you know, he can just wake up and decide he wants a different policy and the market's going to have to chase that. As an investor, though, of course, you have to be a lot more long term, kind of look through kind of some of the short term noise. So as you talk about some of these, I don't know if they're structural in your view, but you talk about the investments in industrials, the investments in, I guess, real economy things. You have confidence that longer term, that's a structural trade that's intact.
Yeah, we do. And a lot of these tend to be, Romaine, longer lived projects. So we looked at some research suggesting that industrials earnings actually hold up the best, even into a recession. And I thought that was awfully strange. But it's because these outlays are very consistent once these projects are committed to. We also think about some more structural issues around, just think about businesses building a factory right now. It costs 5 times more to do so in Europe right now, given prohibitive energy costs there. There are a lot of regulatory measures coming online in China. It's more difficult to do business there as well. A lot of companies are coming to the United States. The Midwest is booming right now with industrial activity. There's a manufacturing renaissance playing out in the United States today. And we think that that's a trend that's going to be more structural. And guess what? You're also not overpaying for it. U.S. mid-cap stocks right now are trading at almost a 30% discount to their large cap counterparts. So to us, that's really the sweet spot in terms of finding quality and finding it at a reasonable price.
Emily Rowland over at John Hancock Investment Management here on Open Interest. A little more than 30 minutes into the cash session today. We want to take a look at some of the big stocks moving in the market. Walgreens, Deckers, two of the biggest laggards out there. Apple, though, probably the biggest point contributor to the S&P. Jess Menton joins us right now. I'll talk a little bit more about a phenomenal day and a phenomenal week for Apple. I was taking a look. This is setting up to be the best week for Apple since like 2021.
And a week ago, last Friday, you and I were talking about this because at that point, Apple was down more than 10% in January. And that was his worst start to a year since 2008. It was getting close to that 200-day moving average. Of course, it was trading at all-time highs at the end of December around 260. But when you see this, and especially the aftermath of those stocks that were tied to AI, obviously it had the Vision Pro, didn't perform as well as some people were hoping, but because of that, it was a little bit more insulated compared to some of its peers this week.
And I'm glad you brought up the 200-day moving average because that was a big catalyst. I mean, a lot of people said that. They said, look, I mean, when you hit that, that tends to be a buying opportunity for a lot of folks out there.
And that happens too because you have money that are stacked up at certain levels like that. So it didn't end up coming back in, especially when I was talking to portfolio managers who were playing the long game with a stock like that. And especially because there was criticism. We talked about the Vision Pro, but Mark Gurman, of course, at Bloomberg News talks a lot and breaks a lot of these stories, especially when we're thinking about the M4 chip that's tied to AI and the graphic processors for this. It's supposed to come out in the spring, but of course their services revenue is the one that came in more than expected. And that's where you have the App Store, you have different payments on there. And so that's actually picking up steam, kind of offsetting some of the slowing growth we would have seen on the iPhone sales.
You know, it's interesting. If you look at the Magnificent Seven, after that 2.7 sell-off, you saw 2.7% sell-off on Monday. We're now up for the week. And Apple, we are now really, what a week makes. But Apple really helping drag up the index now. And intraday, you're seeing up the total Mag 7 up more than 1.7%. I want to move on here. Also talk about Walgreens because you are seeing it have its worst day since June.
It's right. And of course, that was one of the worst performing stocks in the S&P 500 last year. It was down over 60%. It actually rebounded more than 20% this month coming in. But of course, now it's cutting that since it's down almost 16% just to date alone. So obviously you were saying worst session since actually you'd think it'd be longer than that. But to your point, last June. But a lot of this actually is coming coming in because of when you're thinking about also trying to revive its business and the competition it's had when it comes to the retail side, as well as declining pharmacy reimbursements. But Evercore ISI, they actually were pointing out that because of the cost savings that they're trying to go through, they're estimating that basically the suspension could potentially save, and they're talking about when it came to that dividend that they suspended that had been around for almost a century, it could save about $650 million to about basically looking at that for fiscal 2025. So we'll have to wait and see what that remains to be seen here.
Another stock that I'm absolutely floored by is Deckers. This was one of the best performing stocks last year. It was up 82%. They own Uggs, Hoka, Teva. They came out with their earnings here. I guess people are more concerned about the sales outlook. We're not buying these shoes anymore.
That's actually right, because it beat on the top and bottom lines. Also, its fiscal outlook was better than expected, but it came to the freight costs that were tied into that. And it was on the earnings call that executives mentioned that. So that's why you ended up seeing the pressure there. And especially when you're thinking about more globally, supply chains, we talk about this all the time. Also, the inflation component that goes into it. So that's why you're seeing it down a lot. We always talk about, sometimes Romain and I will joke about the Uggs and the Hoka kind of running shoes, but they actually saw more growth, especially in men's sales during the wintertime for the running shoes. But still, it's those freight costs that were pressuring it.
Fascinating. I mean, we've been talking about the front running here. People bringing in more supply earlier to front run.
Well, I saw Ugg sales, the actual just Ugg sales are still up like 16, 17%. And what was it, Hoka sales. Those are things that Carrie Greifeld wears with the thick sole that you look like an old man. That was up 23%. So it was about cost.
It actually was. And so they pointed that out. You're still seeing growth in both of those key segments that are obviously really popular among shoppers.
I am more likely to upgrade my Hokas than I am to upgrade my iPhone.
Do you wear Hokas too?
That's actually true. I've had my iPhone for a while.
Anyways, Jess, thank you so much. That is Jess Menton, of course, of Bloomberg News. We thank you for taking a look under the hood for us. Now, coming up, tariff showdown. President Trump is pledging to slap Canada and Mexico with levies up to 25% tomorrow. Will he or won't he? More on that next. This is Bloomberg.
And now to our high interest, a look at what's making headlines around the world here on this Friday morning. NVIDIA CEO Jensen Huang scheduled to meet with President Trump today at the White House. That's according to Bloomberg sources. The meeting, the latest sign of Trump's growing interest in AI, and comes days after China's DeepSeek rocked the U.S. stock market. We stay in Washington with the Trump administration now looking into withdrawing a key federal authorization that would halt congestion pricing in New York City. That's according to the New York Times. That tolling program began just 4 weeks ago. And down in Mexico, the economy minister there says that imposing 25% tariffs on Mexican goods would be, quote, a strategic mistake. He says the move would raise prices for goods such as vegetables and fruits, cars and refrigerators in the U.S. But President Trump, not deterred, telling reporters that he plans to follow through on his threat for 25% tariffs on imports from Canada and Mexico starting on February 1st. Today, of course, is January 31st, so those tariffs, well, technically would start tomorrow. Brendan Murray, who leads Bloomberg's trade coverage, joins us right now. And Brendan, give us a lay of the land here. When we talk about those 25% tariffs and this February 1st deadline, does that mean this starts tomorrow?
It's unlikely that it's going to start tomorrow. Look, these two countries, Canada and Mexico, account for more than a quarter of all the goods that come into the U.S., all imports. So there's a lot at stake. President Trump yesterday said what he's been saying for a couple of weeks now, that he's going to hit the two largest trading partners with tariffs. Now, that could mean a number of different things if you parse his words. He could announce an investigation that starts tomorrow with a deadline to reach some sort of terms that they can avoid tariffs. He could provide some loopholes and some off-ramps for tariffs. It's our understanding that there are officials from Canada and officials from Mexico are in Washington now trying to negotiate something less than what he's threatened. So there's a lot on the line. If you take the president literally, a quarter of all U.S. imports starting tomorrow are going to be 25% more expensive.
You know, regardless of all the uncertainty, you do have many people preparing in many different ways. We have a story on Bloomberg right now about how traders are loading planes, commercial flights, with gold and silver. It's hard to imagine that, isn't it? How do you see people really trying to get ahead of this?
Yeah, there's another story about how avocado prices, apparently 90% of American avocado imports come from Mexico. So, that's going to be hard to deal with ahead of the Super Bowl. But yeah, it's going to be a scramble. American importers have been scrambling for weeks or even months to try to stock up their inventories in anticipation of these kinds of tariffs. So we'll see, what the president rolls out either later today or tomorrow. But either way, there's going to be big implications for the economy of all three countries, really, and for financial markets as well.
Yeah, and Brendan, I don't really advocate trying to hoard avocados. They actually spoil pretty fast on your kitchen counter, as I've learned. I do want to talk about some of the more, more manufacturing type of sectors that could be affected by this. We saw a big downdraft in Ford and GM the other day when Trump made those comments that he could follow through on this. What flexibility do automakers and those big manufacturers that are set up across the border, do they have any options?
Well, they would tell you that they don't, and if they do, they will take years and billions of dollars to rebuild supply chains that don't extend from Mexico all the way up to Canada. There could be another way, that the president could soften the blow, the economic blow of what he's going to announce, is he could exclude certain industries, certain products from the tariffs, and one of those would likely be the auto industry. Another one, we get a lot of, I think we get 60% of our crude oil imports from Canada. So there'd be big implications for energy prices if he doesn't exclude those industries as well.
Big implications, but a lot of uncertainty still. Bloomberg's Brendan Murray, we thank you so much for all of your coverage and more open interest ahead. Stick with us. This is Bloomberg. Now for an update on the plane crash near Washington. The NTSB have recovered the cockpit voice recorder and flight data recorder from the airplane involved in Wednesday's mid-air collision. The flight path of the Army helicopter is emerging as a key line of inquiry in the probe into the mid-air tragedy that killed 67 people. Let's go to Tyler Kendall now, who is in D.C. for the latest. And in terms of the investigation itself, you did have a board member of the National Transportation Safety Board talking about the helicopter's altitude seen as a factor in the probe of the crash. What more do we know?
Well, Shonali, actually, Defense Secretary Pete Hegseth first floated this idea that there was likely an elevation issue here. We know that the airspace around DCA allows for about a 200-foot ceiling for helicopters that are operating in the area. According to flight tracking data that Bloomberg News is citing, the point of the collision happened at about 350 feet, so that would seem to appear that the helicopter was flying above that designated ceiling. This is something that President Trump, in a post on Truth Social this morning, also pointed out. Now, the Army itself, the Pentagon, is conducting its own investigation. They have said that this was a routine training mission and that actually these pilots were pretty experienced. We know that one Army official says that the lead pilot of this helicopter had about 1,000 hours of operating the helicopter under his belt. Shonali, that's considered to be pretty significant when you take into account that helicopters often go short periods of time, at max normally about 2 hours.
I am curious, Tyler, about what we could potentially learn from the black box that was on that Bombardier commercial jet. Obviously, we talk about this idea of the elevation differential and whether the helicopter was where it was supposed to be. Was there any indication from what you've heard from investigators that the airplane saw the helicopter and had any opportunity to maneuver around it?
There have been reports about that, particularly when we are looking at what was this differentiation in the elevation, but we are still waiting for an official word from officials. Investigators have said that they are going to go about this very methodically and that they're not going to get ahead of their independent review of the facts. Now, there are still many questions remaining here as we try to seek answers and see if maybe any potential NTSB briefing will ultimately be scheduled for later today. But as you mentioned, those so-called black boxes are going to be absolutely critical in this investigation as they try to peel through the data, particularly when it comes to the speed, the projection, the elevation of these aircraft, considering that we heard from Transportation Secretary Sean Duffy yesterday that these that the aircraft were on what was considered to be a standard flight path and that this entire tragedy might have been able to be prevented. Tyler,
of course, families are grieving. What is the latest on the recovery efforts for the victims?
Well, Shonali, the chief of DC Fire says that divers have been able to access all of the accessible locations in the Potomac River, and they're now moving to a second phase of the search mission. That means that we will likely start to see divers today starting to pull out parts of the plane, parts of the debris in an effort to try to recover additional bodies. As we have been reporting, we are not expecting any survivors from this tragedy. We know that 64 passengers were on that commercial American Airlines flight. An additional 3 U.S. service members were on the U.S. Army Black Hawk helicopter. Again, we are not expecting there to be any survivors as they continue worked overnight and continuing today to try to recover as many bodies as they can.
Bloomberg's Tyler Kendall reporting from Washington's Reagan National Airport. And a quick reminder here that the NTSB, of course, is keeping people apprised of that. The latest news on the Bloomberg terminal, now focusing on the flight path and the elevation of that Army helicopter. We'll be back in a moment. This is Bloomberg.
Chili's is coming in hot. Sales at the fast casual restaurant increased 30% last quarter, and it was Chili's third straight quarter of double-digit sales growth. Here to talk about what's driving diners to the Tex-Mex chain, Kevin Hochman, the CEO of Brinker International, where you have just been on a tear. I mean, Brinker shares rose more than 200% last year, up more than 40% this year. I think a lot of investors are just wondering simply whether you can sustain your performance and outperform other fast casual rivals.
Yeah, well, we're well into year 3 of our turnaround. We've been in the gym working out. We've been focused on the fundamentals of casual dining, which is improving the food, simplifying the menu, improving operations, and then creating an atmosphere that guests are excited about. And lo and behold, the fundamentals seem to work. And we've had incredible growth on the top line. We've had margin expansion, all the things that a winning casual diner gets. And we believe it's sustainable just because we've been doing this a while now, and I think it'd be very difficult for competitors to copy in the short term.
We'll talk about that, too, because, I mean, you guys have taken some interesting approaches. You had the big social media campaign, I think, in the spring of last year with the Triple Dippers, and I know you've experimented a lot with various price points and kind of packages or meals, if you will, kind of similar to what you would get in a fast food restaurant, but in this case, in a sit-down restaurant. Why is that working, and can you sustain it?
Yeah, we saw this about 18 months ago. We saw customers were really, quite frank, frustrated with the fast food prices. So we would see them post their receipts from a fast food restaurant for their combo meal online. It might be anywhere from $15 to $20. And then a lot of people would then, pile on there and go, man, fast food prices have gotten really expensive. We saw that. We know we have this great $10.99 meal, which is an almost half-pound burger, fries, drink, and unlimited chips and salsa. And that's lower than a lot of combo meals out there for a much more premium burger, at least we think so. And so we've been able to drive that over the last couple of years. And we now stand for leadership value in the category. You get an amazing meal, the quality's there, and the taste is number one. So that's what's really been driving our business right now.
Have you seen any competition, though, as many of these quick service stops have produced more cheap meals? You have now McDonald's with a $5 meal deal. You've had similar deals from Wendy's as well. Has that made any difference in the types of customers you're getting?
Yeah, the value is what you pay versus and what you get, right? And so it's not just the lowest price point, because we actually had even a lower price point 3 years ago, but we didn't have the service levels and the quality that we have today. And so we believe when you look at the value and the quality that you get at Chili's, it is still going to be leadership. Now, the proof point was this past quarter, we saw a lot of those deep discounts happen. So we saw the $5 meals in fast food. We saw one of our primary competitors go below us by $1, and yet our business accelerated. So we think that's a proof point that it's really not just about the lowest price point. It's also about the service and the quality of the food.
But how are you keeping then your margins? How are you protecting your profits? Because, when we talk about, fast food chains and why those prices went up, there was a reason why McDonald's and some of those other companies are raising prices, because their costs were going up. So what are you doing to sort of keep your commodities costs under control, and for that matter, labor costs as well?
Yeah, well, we've been doing what we call ruthless simplification. So over a quarter of the menu we've gotten rid of over the past 3 years. And when you have less things to inventory, less things to throw out, less things to worry about inventorying, you can get a whole lot more productive, both with the items that you buy as well as with the people that are in the restaurants. And so that's kind of been the number one thing that we think is starting to expand margins. And then obviously when you grow so exponentially, from a top-line standpoint, you can spread fixed costs over a lot more business. And between those two things, we've been able to expand margins while still having leadership value.
I want to go to the big picture now as well, because, of course, a lot of investors and a lot of business owners now preparing for the threat of tariffs that the president has threatened could be right around the corner. Tomorrow is February. And so you see prices, for example, avocado prices this year already having surged on the heels of that threat. How are you preparing for that?
Yeah, so it's not going to impact us that much just because we have a wide variety of basket. There will be some impacts if those things happen. But, there'll also be some tailwinds with the new administration. So we think about it like we think about any other kind of challenge, is like, how do we continue to reduce costs? what are the things that we can do from a sourcing standpoint to offset some of the costs? Because ultimately, like, if we can keep like our $6 margarita $6, or we can keep our $10.99 meal $10.99, no matter where you are in the country, whether you have a coupon or you don't, or whether you have an app or you don't, we can keep those prices fixed. That's actually going to advantage us in the long term. So we're just going to treat this like any other, headwind that we see from a cost standpoint.
Kevin, I do want to ask you about longer term strategy. I mean, you've been in the job, at least at the top job here now for a couple of years. And I'm curious, are you thinking about store expansion, meaning are they expanding the footprint of Chili's, and for that matter, Maggiano's, which we haven't talked about? And I know that's a much smaller part of the business, but what is the longer term strategy to, I guess, expand not just the awareness of the brands, but the actual footprint too?
Yeah. So anytime that you're in a turnaround situation, it's all about improving the floral economics of the restaurants that you own. And we've been able to do that pretty significantly on both brands. So Chili's went from a $2.9 million annual sales to we'll be at $4.2 million this year. We've expanded margins from about 11%, upwards around 16 or 17%. So when an average Chili's is making more than double the amount of profit than they did 3 years ago, it gets a lot more attractive for us to build a lot more. Same thing happened at Maggiano's. The average Maggiano's now does $10 million per restaurant, and we've improved margins to about 18%. So when you got those kind of numbers, it gets a lot more excited about building restaurants because you get a return a whole lot faster.
Not to make it overly political again, Kevin, but one thing that you really have highlighted here is labor costs. And a lot of investors here, a lot of business owners, again, too, as we've been talking about, are concerned that immigration policy could have a significant impact on labor costs. Do you see that around the corner being an issue for you?
Yeah, I don't think policy is changing the fact that wage inflation is going to happen year after year. And what we need to do as leaders is to plan for it, right? So, it used to be in the old days, you could probably offset some, with some cost cutting in order to offset any kind of wage or cost of goods inflation. I think with the fact that wage inflation and COGS inflation have been significant in the last few years, there's only one real answer for that. You do have to cut costs and keep your belt tight. But you also got to accelerate your growth. And that's going to be the number one thing I think that's going to separate the winners from the ones that don't, is you've got to accelerate growth in order to offset all this wage pressure and this COGS pressure.
Hey, Kev, really appreciate you taking time for us. Kevin Hochman there, the CEO over at Brinker International. Best ticker on the street. EAT shares up 1.5% on the day, but on a weekly basis, 24% best week for that stock going back to 2020. Meanwhile, to the downside, two of the biggest drags on the S&P, Chevron and Exxon. Chevron, profit underperforming expectations amid crude prices, but the oil giant also raised its dividend, 5%. Mike Wirth had a chance to say, the CEO over at Chevron, sat down with our very own Alex Steele. Here's what he had to say.
The key thing for companies is to be resilient through price cycles. In a commodity business, you always have to be prepared for the downside. We have a very strong balance sheet, a AA credit rating, just 10% net debt. We're seeing rising production and a lowering cost structure and a lower capital spend. And, we've got confidence that the free cash flow over the next 2 years will increase by another $10 billion.
And that was Mike Wirth, the CEO over at Chevron, the person asking the questions, Alex Steele, the co-host of The Close. And believe it or not, she's here on The Open. Look at this collaboration, wire to wire with The Open and The Close.
Threatened I'm being taken over.
No. This is called collaboration. This is what the whole network should be doing. Talk to us about Chevron. Because I look at this drop in the shares on Chevron and Exxon. Is this all about the refinery profits, for refinery revenue?
So it seems to be.
Yeah.
So basically when your feedstocks, your input costs go up, what you make on those products goes down. And that hurt both of them. Now the difference is that Exxon lowered expectations for the quarter weeks before, and that stock really tanked after that. And then they over-delivered. Chevron hadn't made that announcement yet. So that's why Chevron's getting hit a little bit harder. Plus, it just started its field in Kazakhstan. It's called Tengiz. And some of the analysts are saying that the cash flow there was a little bit lighter than they thought. So that's one Chevron-specific item.
It's interesting. If you look at the energy index writ large this year, it's only up about 2.7%. It is kind of one of the worst performers in the S&P 500. And the dispersion is incredible. You have stocks up about 17, 18% when you look at Baker Hughes, Texas Pacific up more than 14, 15%. But then you have Occidental still down on the year. Can you explain where these two giants kind of fall in the scope of things? And what they have to say maybe has a ripple effect?
Yeah, so the stocks that have done well have been power related or oil services related, but more in particular LNG. uncertainty, and that's that Baker Hughes story. The big oil guys, it's going to be a struggle. There's a couple things. How do you continue to produce oil for cheaper, and where do you do that? The big question for Chevron is, do they wind up buying Hess? They've been in arbitration with Exxon for over a year now. It's a $53 billion acquisition. They want Hess very badly because it has a super juicy Guyana asset, which is like the growth area for the next decade or so. And Exxon doesn't want them to have it, basically, and they say that they have right of first refusal, and that's putting this tension within the oil market between those two guys. But also, tariffs, demand, China, that's not good for the oil guys.
Well, talk about tariffs. I mean, did you ask him about that? Did they provide some commentary? I mean, Trump is basically saying tomorrow's the day he's going through with this.
So
25%.
Yep.
Canada.
Yep. So I asked Mike in particular about that when it came to those refining margins, right? Because if you get, say, oil from Canada, heavy oil, a lot of the refiners in the U.S. use that oil, not the oil we make here in the U.S. And I said, is that going to raise your feedstock costs? And he's like, well, our refiners are on the Gulf Coast, mostly on the coast, I should say, so they don't use that oil, which really goes to the Midwest. But then I asked, what happens if we have more sanctions on Venezuela? Chevron produces oil in Venezuela. That's also heavy oil. He's like, yeah, it's going to be tough, and we're going to see higher prices because of it.
A lot of headwinds.
Yeah, absolutely. And then I'm always intrigued by how much oil goes back and forth across the borders with the U.S. Again, like, don't we take their stuff, refine it, bring it back to them, and they sell it back to us? So it's a bit of a mess. We can hear a little bit more from that interview that Alex had with Mike Wirth a little bit later, right here on Bloomberg this afternoon. On the close, that's going to come up on 3:30. It's not a takeover, Sonali. It's collaboration. You can hear that interview in full at 3:30 p.m. New York time. Meanwhile, a lot more coming up right here on this show, which I'm told is called Open Interest. Regional Fed Presidents Neil Kashkari and John Williams, along with J.P. Morgan's Priya Misra, they had a chance to discuss how inflation is impacting Americans across the country. That's coming up next on our Wall Street Week conversation. This is Bloomberg.
And it's time for our daily Wall Street Week conversation. The Fed has decided to keep interest rates unchanged for now. But how are rates affecting everyday Americans across the country? Bloomberg correspondent Michael McKee spoke with Neel Kashkari, John Williams, and Priya Misra about how inflation is often felt more acutely in rural areas where household wealth tends to be lower.
Is the experience of inflation different here in your district in the Midwest and to the West than it might be in New York on Wall Street?
I think so. I mean, I think especially when you go out to rural communities, we have a lot of rural areas, the challenges that families are facing are different. I mean, they're all facing the higher prices that virtually all Americans have faced, but they also have acute challenges. Hospitals are closing in many rural districts because there's not enough population to support those hospitals. In some cases, colleges and universities are closing. It's hard to get home construction built, even though there's a lot of land available, getting new construction and new development built. So the challenges in rural communities are different, but a lot of times they're driven by price as well. So there's some important similarities, but there's some specific differences in rural communities.
For the likes of Neel Kashkari and Austin Goolsbee, a large part of their districts cover vast rural areas. While a big focus in John Williams' jurisdiction is naturally on Wall Street in New York City, where analysts and traders immediately dissect any inflation data, not just looking at the headline number, but peeling back the layers to look at individual contributors, which can vary widely.
You get the headline number, the core number. Literally the next second I look at services. So services versus goods. Then I look at where's shelter. And what has been high, so what's keeping inflation high is not a broad-based higher inflation across. Then I would be a little nervous that are we getting stuck somewhere above 2? It's really a couple of components. It's shelter, it's lagging, Zillow rents are coming down. It's just taking a while. People who own their homes, it takes a while for that to show up in the data. So there's a lag there. Auto insurance, medical insurance, these are imputed numbers. That's why I think it's actually good for them to have that flexibility, because why should they keep policy high just because shelter inflation, which is owner's equivalent rent, is running above target just because it's adjusting slowly.
For those in the markets every day, like JP Morgan's Priya Misra, communication is a critical part of a Fed president's job. And a clear target, 2%, makes that job a lot easier.
Well, you know, inflation is different in different parts of the country, and it can be different at different times. I think that, you know, where this became easier, unfortunately, was when inflation was high, and everybody said inflation. It was high everywhere. Inflation was clearly damaging to the economy. It was harmful to families and businesses. Everybody wanted to see inflation lower. I think the communication of the 2% goal was incredibly powerful during this period because we weren't questioning what we should get inflation to, what does good look like. We said absolutely we need to get to 2%. We're consistent on that. And I think people understood that, the importance of price stability, the importance of getting inflation back down. I think that was, you know, regardless of all the debates of exactly how did you come to 2%, it was a very clear, strong message. It's a message that Chair Powell repeated over and over that, you know, we're not compromising on achieving that.
7%.
And that was Neel Kashkari, John Williams, and Priya Misra. You can catch Wall Street Week tonight and every Friday at 6 p.m. Eastern. This is Bloomberg.
Welcome back to Open Interest here on the final trading day of the first month of the year. And ETF investors seem to actually be pulling back slightly from that post-election rush into equities. Inflows to U.S. equity funds now at their lowest since August. Eric Balchunas joining us right now, Bloomberg Intelligence's senior ETF analyst. And let's start off.